Hello everyone, Chad Slagle, President and founder of Slagle Financial here with your monthly update on the economy, the markets, and some new strategies that you would definitely want to take advantage of. The hot topic this month is a Silicon Valley Bank, the nation's 16th largest bank that was seized by regulators. What exactly happened and why, and how does it affect you and your retirement, and where do the markets and the Fed go from here? So how does a recently thriving financial institution get to this point? There were a number of contributing factors. SVB provided financing for about half of all U.S. venture-backed technology and healthcare companies. SVB was a preferred bank for the tech sector because they supported startup companies that not all banks would accept due to the higher risk. And then, of course, the pandemic in 2020, as we all know, was a hot market for tech companies because we all spent big money on computers, digital service, and electronics because we were all stuck in our houses. Therefore, tech companies had a large influx of cash, and SVB services were needed during this time to hold that cash for business expenses such as payroll. The bank then invested much of these deposits as banks typically do. And now, since COVID and the pandemic is pretty much over, we're not stuck in our houses anymore, so the activity in the tech sector has dropped off over the past year. The bank had its deposits tied up in low-yielding treasuries, which have dropped in value due to the higher interest rates. SVB tried to raise cash by selling stock, and when that didn't go well, they had to sell treasuries at a loss. Of course, customers got scared, lost confidence in the bank, and withdrew their funds, causing the bank to fail. Now, the FDIC, as we all know, insures deposits up to $250,000, and the majority of SVB customers had more than that deposit in the bank. Now, the U.S. government has said it will waive the deposit cap and all depositors will get their money, allowing tech companies to pay their bills and payrolls. So here's the question. Are the activities of the last few weeks a sign of a bigger banking crisis? Our team does not think so. Keep in mind that regulators watching dozens of banks even in normal times. And of course, additional scrutiny is to be expected in light of recent events. However, markets do not like all the negative headlines. The recent bank events led markets to drop significantly in the past few weeks, and the Federal Reserve raised interest rates on March 22nd by a quarter point, the 9th increase in a year, pushing ahead with its aggressive campaign to tame inflation despite financial turmoil following Silicon Valley's bank collapse. Now, the Fed is anticipating one more quarter point increase to a peak range of 5 to 5.25% in line with its December estimate. As we've mentioned in previous Coaches' Corners, the past few months, the Fed is going to chase inflation until it catches up with it, hence the volatility. You should know we're keeping a close eye on these events and how they impact your investments, and I think a big lesson to take away from the Silicon Valley Bank crisis is how important it is to be diversified over a lot of different sectors with your investments and to make sure you have money in all three buckets, the secure bucket, the growth bucket, and that extra or dream bucket. And one strategy that I think it's important for you to take a look at is if you have low interest bearing accounts like CDs, bonds, or old annuities, you know interest rates will not stay this high forever. So if you have accounts that are only making 2, 3, 4%, you may be able to reposition those into new accounts that are making 5.5%, 6% or more. And they may be more advantageous, tax advantageous for you as well as your beneficiaries. If you want more information on this strategy, or if you have any questions at all on what I've covered this month, please do not hesitate to give our team a call at 888-294-9248 or come into any of our offices in Florida, Illinois, or Missouri. As always, we look forward to helping you every step of the way on this journey through retirement.